Imagine India as a giant city. In the center of this city stands a control room. Inside sits the RBI governor. One day inflation starts rising, vegetables become expensive, house rents climb, fuel prices hurt family budgets. People begin asking, why is everything becoming so costly? The RBI decides to act. It presses a button. The button is called repo rate. But here is the mystery. The RBI doesn't sell vegetables, it doesn't build houses, it doesn't manufacture fuel either. So, how can changing one interest rate affect millions of prices across the economy? The answer lies in the monetary transmission mechanism. Think of it like a row of dominoes. When the RBI changes the repo rate, it pushes the first domino. The effects travel through the entire economy. Let's see how. Suppose the RBI increases the repo rate. This means banks must pay more interest when borrowing money from the RBI. Banks don't like higher costs, so they pass the burden forward. Loan interest rates start rising. Home loans becomes costlier. Car loans becomes costlier. Business loans become costlier. Suddenly, people think twice before borrowing. A family postpones buying a house. A company delays opening a new factory. Demand in the economy begins slowing down. When demand cools, businesses find it harder to keep rising prices. Gradually, inflation starts coming under control. Mission accomplished. But the story doesn't end there. Imagine the economy is weak, businesses are struggling, jobs are disappearing, consumers are spending less. This time, the RBI presses the button in the opposite direction. It cuts the repo rate. Banks can now borrow more cheaply. Banks reduce lending rates. Loans become affordable. Families buy homes, people purchase vehicles, businesses invest in expansion, economic activity picks up, growth accelerates. This entire journey from the RBI's decision to its impact on borrowing, spending, investment, growth, and inflation is called the monetary transmission mechanism. But here is the twist. The dominoes doesn't always fall perfectly. Sometimes banks do not fully pass on rate changes. Sometimes global oil prices rise. Sometimes economic uncertainty makes people save rather than spend. As a result, monetary transmission can be slow or incomplete. That is why economists closely watch how effectively RBI decisions reach ordinary citizens. In simple terms, monetary transmission is the process through which changes in the RBI's policy rates influence bank interest rates, credit availability, spending, investment, inflation, and economic growth. Think of the RBI as the driver of the massive vehicle called the Indian economy. The repo rate is the steering wheel, and the monetary transmission mechanism is the system that ensures the driver's movements actually reach the wheels. Without transmission, the steering wheel moves but the vehicle doesn't.